Hi, good morning, everyone. I'm Jason Hans, and I'm a director in the Financial Reporting Advisory Services at Crown Horn, Singapore. So essentially, the agenda for today's webinar is to kind of, run everyone through what are the areas that you need to look at when you're preparing your financial reports. And there are certain areas which are more important starting December 19, but the other ones, the other areas might be relevant for the other year ends. Especially with the March year end just past us and the June year ends approaching us soon. These also apply to your quarterly reporting. So while you may or may not have seen impact of these implications on your December 19 or March, but then the quarterly results, if you prepare those, will also be impacted. So with this, I'll probably just start my session, and we'll also have a few polls as we go along, and towards the end we'll have some time for Q&A. So feel free to post your questions, and then I'll take it up towards the end. Right. So I think the first question that we're gonna look at is the going concern. The key question that you really need to ask, whether you're a December 19 preparer or a March 20 or a June 20 or any year end, is how is this COVID-19 outbreak and the restrictions which have resulted because of the outbreak impacted your business. So for instance, you see airlines, travel, restaurants, they're significantly impacted, so much to that extent that their very survival is at stake. Because they can't really operate. And if you look at the recent relaxations, again, some of these entertainment and social based businesses are not going to see any relaxation in their businesses in at least in June as well, if not beyond that. So I think the first thing you need to consider is the going concern. Now, what is going concern? So generally, when we prepare our financials, we prepare it on a going concern basis, which really means that the company is expected to meet its obligation in the next 12 months. There's no intention of liquidation or cessation of business. There are no circumstances that are expected to arise in the 12 months following the reporting year end that may force the entity into liquidation. However, having said that, this outbreak and the restrictions may actually challenge that assumption. And why it's relevant even for the December 19 preparers is that, typically the auditors would look at it right through to the signing date. So, your business may or may not be impacted as much, but there's definitely going to be more inquiries, more questions, and more data requests from the auditors coming in, because they would probably want to make sure that the business is viable for the next 12 months and it can meet its liabilities as and when it falls due. So they're going to ask for cash flow forecast. They're going to ask you for whether you're going to line up more funding, take more loans, different ways wherein you will have liquidity to sustain your operations for the next 12 months. If you fail this test, if you fail the going concern, then the alternative basis is liquidation basis or breakup basis, which really means you prepare your financials as if everything is on sale. So the liquidation basis is not normal. I mean, every one of us, we really don't assume the going concern is going to be affected when we are preparing our financial statements, but this COVID-19 outbreak and the consequent restrictions has actually challenged that in a big way. So as part of your year end, I think the key thing would be to really do a business forecast to see how you're going to survive this crisis and how you're going to maintain your liquidity and make sure that the business doesn't go under. Now, this is important. This is important because obviously the management is probably already doing it, but auditors also have an obligation to report on the going concern, and that's where it becomes important from a financial reporting perspective that you convince them that there's nothing going to be wrong, else you're probably looking at a liquidation basis of financial reporting. So before I go into the next question, I think we'll run a short poll to see really how the audience is kind of already gearing up for the going concern. So Casey, can I request you to kind of run that poll? So I'll give everyone a few seconds to kind of fill this up, and then we can quickly, and I'll request everyone to answer it so that we really, at least in the group, we can see, how we have at the moment thought for it, whether we have thought for it, not thought for it, and we we can then take it forward from here for the presentation. All right, so I'll continue with the next topic, which is events after reporting date. So again, continuing with this impact of COVID-19, I think we also need to look at how the operations have been affected after the year end, and this is particularly important for December year ends and January year ends, if there are any. The reason being is there's a concept of events after balance sheet date, which requires companies to assess impact of events that affect the values of assets and liabilities that existed at the balance sheet date. Now, from a December year-end perspective, there is a general consensus that this entire COVID-19 outbreak is a non-adjusting event. The primary reason is that in December it wasn't widely spread. It was just restricted to. It was just identified. It wasn't declared a pandemic. It wasn't declared a disease which was of international concern. All those events happened subsequently in Jan, when it was identified by WHO as a disease which has an international concern, and then subsequently sometime in March they declared it as a pandemic. So essentially for 31st December, you would not go back and start changing the values of your assets and liabilities because your business has taken a beating in the subsequent period. But what you'll need to consider is the disclosure aspect, which I'll cover in a short while. But however, judgment is required whenever these things are concerned, because sometimes circumstances existed which probably have been accelerated by this COVID-19 situation. So for instance, your customer was already in trouble at 31st December 19, and what this COVID-19 did was just to accelerate the process of bankruptcy, because their business dried up and they can no longer sustain, and they filed for bankruptcy. So this might be an event which provides you more information about conditions that existed at the balance sheet date, but it's an area of judgment. So for December 19 year ends, the idea is you treat it as a non-adjusting event, but then look out for specific balances where you think they were already you have better information in the subsequent period, which provides you which maybe requires an adjustment in the December 19. For year ends after December 19, especially the Jan and Feb, it's a lot of gray area, because there's no right or wrong answer for that. So it really depends on the level of your business exposure to China, because in January especially, this entire outbreak was restricted to China, and more specifically Wuhan and the Hubei province. So if your business had supply links or demand links to those areas, then yes, it's probably an adjusting event for you. But if you don't have any exposure to those areas in China, then you're probably again a non-adjusting subsequent event. For March year ends, it's not a post-balance sheet event. It's an actual event that happened in the year end. So for those companies, it won't be business as usual. So the next couple of topics that we discussed for March year ends and June year ends, they'll have to take into account the impact of COVID-19 and the restrictions while preparing a financial statements. So once we've identified it's a non-adjusting events, we need to consider disclosures, and those disclosures, if there need to consider whether there are significant changes to assets and liabilities in the future period that should be recorded in that have occurred since the year end, and the effect of these events on the future operations of the entity. So some of the common examples I've listed on the slide. Again, going concern is one. Breach of covenant. So you have a loan because of and you're required to maintain a certain current ratio or a certain EBITDA margin, but because of the restrictions and the lockdowns and the circuit breakers, your business is not operating as normal. You're not able to meet those covenants, which would then trigger this disclosure. Assessment of certain sale and purchase agreements as onerous contracts. I'm going to come to this later when we're in the revenue section. Any restructuring that you might undertake after the year end is again a post balance sheet event, which is non-adjusting in nature. So you need to disclose that. Entering into significant commitment or any contingencies that you may face, and it's always good to have how some description of how the management intends to deal with the crisis. Now the key thing is, when it comes to subsequent events disclosure, we typically use to a qualitative assessment, and we generally give a narrative. But now that you have a crisis, and some companies in certain sectors will see more impact. If I take examples, say for the restaurant or the F&B business, there it's been closed for the last 2 months, and seems like it would be closed for some time more. I know they're doing takeaways and deliveries, but they're still not operating at an optimum capacity. So in those scenarios, the management may also have to, give quantitative details. So, whether there's an impairment, whether the inventory write down has occurred in the subsequent period, retrenchment, and what the cost of that retrenchment was, so on and so forth. I think there will be a lot of focus on quality disclosures around COVID-19 to really explain to the stakeholders how this event has, impacted the company's performance in the subsequent period, and what the quantitative impact is. Again, for certain companies, it may not be straightforward, so they may still continue to, give qualitative disclosure. But I think that's something that each of us will have to consider on a case-by-case basis. I think if you look at travel, aviation, restaurants, these are the industries which are significantly impacted. Movie theaters, and these are the areas where probably a quantitative disclosure would be required compared to others which have not seen as significant impact. The next is government grants. So we're seeing governments everywhere coming out with bailout packages. So the bailout packages could include, could be in different shapes and form. It could be interest-free loans. It could be direct cash transfer for purchase of assets so that you can spur production. It could be direct cash transfers for supporting the companies meet their employee costs. So it can be in different shapes and forms. Essentially, whenever you have government grants, FRS 20 comes into play, and what you really need to look into is that how you need to account for it. For fixed assets or property, plant, equipment related grants, you can either net it off from the cost of the asset, or you can set it up as a deferred income and release it to P&L as other income over the period, or set it off against the depreciation charge. That's a choice. For grants which are related to expenses such as salary cost, and that's something that you again release to P&L if you recognize and release to P&L and recognize in other income, or as a set off against the salary cost in the period in which it happens. If it's on a real-time basis, then you would probably not need to set up a deferred income. If it's received upfront for say 6 months, then you'll need to set up a deferred income even when such grants are related to salary cost. So next we have current non-current classification. Now this is important, especially when you have companies have loans, and those loans have covenants. So just a couple of slides back I discussed it's a post balance sheet event, but say now we move forward and we have a March year end, and you have a scenario where your covenant has breached, right? So in this case, the breach of covenant means the loan becomes repayable on demand. Now, if the loan becomes repayable in demand, it now needs to be presented as current under FRS. So what it would really do is it'll impact your current ratios. It may impact your gearing ratios. It could impact your other key performance metrics that the management of the bank is monitoring, or it could result in a cross default. So you breach a covenant on one loan, which affects your working capital, which then results in an impact on your key ratios, which results in a default on another loan, which again then gets reclassified as current. So I think the key point one would need to take care over here is that you test for your compliance for the bank covenants, and then essentially renegotiate with lenders wherever possible, so that so in today, because of COVID-19, there's a lot of renegotiation with the banks. There's a lot of debt restructuring. So I think covenant testing and then evaluation of whether a renegotiation is required is an important task. Otherwise, it can really have an impact on how you present your current, non-current classification for loans. Similarly, the asset side also may get impacted because it's also based on the expectation and ability of recovery of such assets. Therefore, the asset classification may also undergo a change. But I think the bigger and the more important aspect is the loan classification, which can have severe consequences for certain companies. Impairment of assets. Now, we all know because of the COVID-19, there is an impact on demand. In certain instances, there might even be impact on supply because a lot of the shipping and international trade is impacted. So impairment of assets has to be performed. This COVID-19 and outbreak is an external trigger under FRS 36 or IS 36, which necessitates the company to take a more detailed, formal impairment assessment. Now, the key question that we've seen from some of our clients is, should we assume business as usual, right? So clearly, you can't assume business as usual in this case because we don't know how long is this outbreak is going to play out, what kind of an impact it may have on the overall economy and the demand. We really don't know how much time the demand may take to recover. So I guess the companies will have to factor in the new normal now, that it may not be whatever they budgeted for 2020. It might be quite lower than that, and accordingly project their future cash flows. The second element would be the discount rate. Again, the discount rate may undergo a change, and it's really specific to the companies because some companies will see their credit spread go higher, the others may not. So it really depends on which sector you are, what the financial health of your company is, and accordingly the discount rate may undergo a change. So let's assume the future cash flows expected future cash flows go down, the discount rate shoots up. The combined impact of this would mean that the value has decreased because my projections have gone down higher, and I'm discounting it by a higher rate. So I have a lower value, which means I have an impairment loss that I'll have to recognize in the financial statements. Okay, just a second. Something happened to my laptop. Yeah, sorry. So yeah, impairment is an essential. Impairment assessment will be a key focus area. Should be a key focus area for the March 20 and the June 20 year ends. Because the pandemic was already declared, the restrictions in a lot of the countries already were imposed, and you can clearly see the effect of the lockdown or the circuit breaker in a lot of the economies. So this is an area where management should spend some time evaluating how they need to prepare and update their existing impairment testing model. And I'm pretty sure the auditors are going to ask for these details as they start their audit. Inventories. So again, similar to the impairment of assets, you may face issue with inventories if you have unsold inventories which have prices which are expected to fall significantly. You may also see the costing undergo a change if the utilization level of the plant undergoes a change. So essentially, as everyone knows, we need to do a cost versus NRV test every year. So you may see at the year end when you're preparing your financials that the NRV has really gone below the cost, which may then trigger losses on these inventories because of this. The other thing that we keep in mind is the production. So a lot of our plants are sitting on idle capacity. They may not be working at all. So the standard says that whenever you do allocation of fixed overhead, it needs to be done on normal capacity. So Now, normal capacity does not take into account unpredictable events like one-time shutdown or demand constraints. But with this COVID-19, again, we really don't know how long it's going to play out. So your normal production capacity may undergo a change, and if that happens, then your entire costing will undergo a change, and then you can only allocate fixed overheads to the extent of your normal production capacity. So if the normal production capacity goes down, you may not be able to allocate everything onto the inventory, and whatever is not allocated essentially is your cost of goods sold. So again, it may result in some uh, profit impact for certain types of companies. But again, it's based on case to case. Companies should review their costing. They should review their demand projection and accordingly make amendments to the costing, and they should again do a more robust cost versus NRV test for the year end. Borrowing cost. So borrowing cost, there isn't much impact on borrowing cost other than the fact that if you have a plant which is under construction, which was funded either through a specific loan or a general borrowing pool, but you may see suspensions in production or construction activity due to the lockdowns. So during the period when the construction activity is suspended either due to lockdown, non-availability of labor, non-availability of resources, you'll have to suspend the capitalization of borrowing cost, which really means any interest that you pay during this period will be charged to P&L. So a bit of a profit impact arising from non-capitalization of borrowing costs during the period when the construction plant or construction of the plant is being suspended. Financial instruments. So I think financial instruments, three key areas you need to focus. Whether you are planning to refinance your old loans, does your company have financial assets or liabilities carried at fair value? Whether the companies have lending activities. Now, I'll take each of them in turn. So if you have a refinancing situation, say you have an old loan and you're renegotiating the terms with the lenders and existing lenders. So there can be two scenarios where you take a loan and then you refinance it with a third party lender. So that's simple because your old loan closes and the new loan is a new loan. And any gain or loss that you make on this, it can be easily identified and calculated. But say you have undertaken a restructuring with the same lender, then you would need to apply a concept called modification accounting under IFRS 9 or FRS 109, which basically means that you recalculate your effect. You calculate a gain or loss based on the new terms. So you discount the new cash flows using the original interest rate and see how much gain that you have. So if you if you push the terms ahead, if you say ask the bank for an extended term, the bank may charge you certain additional interest. Now the combined effect of that could be that your new loan is more expensive than the old loan, which basically means you have a loss. Now, instead of recognizing the loss over the tenure, IFRS 9 would force you to recognize the loss now. So your 2020 financials may get impacted. Wherever you have already undertaken a debt restructuring or are in process of doing so, you'll need to keep a close eye on what that modification results in. The second element is assets which are carried at fair value. It could be through P&L or OCI. You will really see the values value swings or fluctuate significantly during the year, especially because of the COVID, because a lot of the assumptions related to cash flows and the discount rate will have changed significantly, and you'll continue to see a lot of volatility because these assumptions would change from month to month, quarter to quarter, because as the situation unravels and unfolds. The next element that you would need to probably consider is the expected credit loss. As we know, expected credit loss model requires you to predict your future losses. So which essentially means you look at your history of losses and also take into account macroeconomic data, forward-looking information about the company, and then come up to an estimate of what the company believes is a provision for bad and doubtful debts. Now, with this COVID-19, you may actually see a lot of your customers defaulting, and you may also see a lot of your customers delaying payments, which can then result in a significant increase in credit risk. Your historical loss rates may start going up, or if it's post year end for existing customers, that's a good indication that your forward looking information needs to factor that in, because those customers which you have on 31st March 20 may already have been impacted, and with the ongoing restrictions their situation has worsened, necessitating an increased ECL provision. So again, more time will be required by the companies to spend on assessing the ECL, and determining whether there is a need to uh, have a higher provision for bad and doubtful debts. And similarly, it's not just for trade receivables. You may see that for other assets, other receivables, everything. You may see credit risk going up for your counterparties, based depending upon which sector they're in, and different companies obviously will have different experience. The other element would be the hedging. I mean, if your companies has entered into hedging strategies to manage volatility of forex, interest rates, etc., then again you'll need to reassess the hedging relationship. You'll have to reassess the hedge effectiveness, because a lot of the variables that we have discussed related to the interest rate, forex movements, etc., they've seen sharp swings in the recent period. So the hedge which was effective maybe 2 months ago may not be effective now. So if it's not effective, then you'll have to discontinue with the hedge accounting. So again, some of the areas that you'll need to revisit when you're preparing your financials during financials for a year end, which kind of occurs during the COVID-19 period. Leases. So normally leases is straightforward, but with the current COVID-19, we've seen a lot of companies seeking rent concessions from the landlords. Now, if your company is also in the process of doing it, the default accounting under FRS 116 means that you do a lease modification, which really means you recalculate your lease liability, and to the extent you can adjust, and to that extent you adjust your ROU asset. If your ROU asset is fully depreciated, then you take that gain or loss to P&L. Now, because for companies which have one or two leases, it's still not that big a task, but for companies which have many leases, this can be an onerous exercise, and that's why ISB has proposed an amendment to IFRS 16, which basically gives them an option, which gives lessees an option to account not to account for rent concessions as lease modification if they are a direct consequence of COVID-19 and they meet the following conditions. So essentially, the revised rent is substantially the same or less than the original. So if you renegotiate your lease and your rent is same or less, so you basically get the landlord waives 3 months rental for you, and thereafter it resumes to normal, which means your new lease payments are lesser than the original because the term hasn't changed. Or he says, okay, I'm going to delay the payments for these 3, but I'm going to spread it over the rest of the term, which means the revised consideration is the same. So then you can still apply it. But if it results in an increase in the consideration, then obviously this exemption is not allowed. The reduction in lease payments relates to payments due only in year 2020. So the reduction should only be for payments which are due in the calendar year. It should not be for 2021, 2022. And there are no other substantive changes that have been made to the terms of the lease, which means the other terms and conditions, term, renewal options, termination options, all those remain the same. So if these conditions are met, all you need to do really is, whatever rent reduction you have, you recognize that as a profit or a gain in the current period. You don't change your FRS 116 calculation; it continues as it is. This is at an exposure draft stage right now. The comments are expected by ISB by the end of May, so we should see a final standard soon, which will be effective immediately, because the ISB wants companies to take advantage of this. Once that is done, we expect similar amendments to be adopted for FRS 116 by the ASC in Singapore. So I guess companies will have a choice when they're preparing the financials whether they want to avail this exemption or not. So that's probably going to be an action step for the year-end closing. Restructuring. So when you do restructuring, there could be different scenarios that you may see. You may retrench staff. You may lay off people, and you have to pay them some money to kind of let them go. So you need to then decide whether it meets the criteria under FRS 37 restructuring costs, whether you can provide for those costs in, let's say, March 2020 itself, or does it become an expense for the next year? So there are certain criteria that you'll have to fulfill under 37. So that's one thing you'll need to take care. Then there could be onerous contract situations. So for example, you have a contract with a customer, and you have compensation for delays or non-performance of non-satisfaction of performance obligation. So some of the delays that are caused by COVID-19 or the restrictions around it may result in either a delay or the company not being able to perform as expected, which may trigger certain penalties, etc., which probably would need to be recognized. Alternatively, in order to maintain your business relationship, you still you still continue to serve the client even though you're making a loss on it because you're procuring raw materials from alternative and expensive sources, or you're forced to pay your staff more. So in those scenarios, again, there is an onerous. This contract becomes onerous, and the expected loss would need to be provided now. When I say now, in the year when you take this decision, the important thing is, for sale of goods, it probably won't make much of a difference. But for long-term contracts, it has a significant implications, because if in a normal scenario, you would have recognized revenue and additional cost over a period of time. Let's say you're in a construction activity and you still have to do construction, but now because of this event, your cost of labor has increased, because whenever the construction opens up, little labor is available and they're charging a premium. Similarly, the construction material is available, but it's available at a higher rate. So that kind of throws your costing out, and you're not able to pass everything on to the customer. So the loss that you foresee that you will make on this project, you'll have to recognize it today. You can't just let it run its normal course, because now this contract has become onerous. And the way the standard defines onerous is any contract where the cost of delivery is more than the benefits that you expect. But it's only restricted to contracts. You can't provide for a foreseeable business loss. This assessment has to be on a contract by contract basis. So yeah, restructuring would probably trigger a couple of areas where you'll need to think and evaluate how to account for it in an appropriate manner. Revenue. So important question: if you deal with commodities other than essential during this pandemic, and do you have contracts which involve volume discount, timeline-based milestone payments, liquidated damages, etc. So the key thing is, if you are in a business which provides essential commodity, you're not impacted. You're probably doing better than expected, because the volumes might be high. But generally speaking, there is a decline in demand for goods and services, and as I discussed earlier, while your product may have demand, but you may not be able to deliver it in a timely manner or in a satisfactory manner. So a couple of things that you need to keep into my mind is, while for revenue recognition, is the impact of those events on your ability to fulfill your performance obligation. This could impact either the timing over which you deliver revenue, especially when it's a revenue which is being delivered over time, or you may have situations where you have variable consideration, and you have sales with right of return clauses. So certain clauses may have volume driven discounts. You have penalties, etc. All these areas may get triggered, because the volumes may not be there. So your initial expectations around your variable consideration may change. So whenever you have a tiered pricing structure, you calculate your weighted average revenue based on the expected volumes. Now, the volumes have declined, that may undergo a change. So you may have to revisit your revenue recognition methodology. Your returns might increase. So you now, if you sell on a returns, you do sales on return basis. Earlier, your return rate was 2%, but now it has gone to 5%. So you need to factor in this additional 5% when you're doing your revenue recognition calculations for the year end. The other area that you'll need to look at is credit risk. Now, credit risk impacts revenue or your financial statements in two ways. On day one, it impacts under IFRS 15. So if the credit risk is high, you can't really recognize, you can only recognize revenue to the extent you expect you'll be able to collect the money. And thereafter, any deterioration in credit after revenue recognition is considered as a bad debt or a doubtful debt. Now, if there is a general increase in credit risk for your customers, then you may actually see pushback or challenge in recognizing full revenue for some of those customers, because they're not paying on time. They don't have the intent, they don't have the ability to pay on time, or they don't have the ability to pay at all, or they probably have an ability to pay a partial amount. So given the way FRS 115 rules are, if you start seeing instances where some of your customers are not paying the full money, they're renegotiating concessions or asking for concessions, or they're taking more than normal time to kind of pay you, it can trigger two things. If they're not able to pay, you can't recognize revenue unless and until they pay up. If they're not able to pay the full amount, so say then you recognize only revenue to the extent that you expect them to pay. So say you do an invoice of $100, but based on your track record, a recent track record, they've asked for additional discount of 5%. So your revenue recognition will not be $100, it will be $95. If they've started taking longer time to pay, then you should also assess whether there's a significant financing component in the contract. So let's say your customer earlier used to take 9 months to pay you, and now they're taking 15 months to pay you because they said that whatever debts were due, they won't be in a position to pay you now because of this, and they want another 6 months before they can pay you. So which pushes this 9 months to 15 months. Now, whether you have a financing component which requires splitting up the interest component from the revenue number is something you'll need to think about and and conclude, which again impacts your financials because interest is not revenue from operations. So it may impact of your key performance metrics in the financial statements. The next topic that we have is non-current assets held for sale. Now, non-current assets held for sale essentially means you have already identified certain assets which you wanted to dispose of and sell in the market. And the standard generally says that you have a period of 1 year to kind of make that sale. Now, with this outbreak, there can be two things. A, you may not find a buyer. So whether you can still continue to call it held for sale is the first question. And the second is the value, because once you classify an asset as held for sale, it is carried at lower of cost or fair market value. The fair market value of these assets may also decline, especially if it's PPE, property plant equipment, which has relatively illiquid market, you'll see the values go down further. So I guess these are the two areas you'll need to consider at the year end, whether you can still classify them held for sale, and for that you'll probably need a more strategic direction from your board or a governing body to see if there are any change in plans, or if the management still continues to pursue options for sale, and if they still believe that 1 year period under the standard can be achieved. And then obviously the second is obtain fair values, for which you may have to engage in external independent value. Share-based payments. So for companies which have share-based payments, the impact of this is that some of your new grants, the value of the share-based payments may go down. So as a result of which, the companies may have to redraw their share-based compensation plans with employees. The other is when companies have classified these as liabilities, the fair value of these liabilities will also fluctuate like any other financial instrument. So you may see a charge to the P&L arising from the fair valuation. The other element would be the vesting, because of the slowdown, companies may not see achievement of performance targets possible, which may impact the vesting. So, again, as I said earlier, the overall plan may have to be revisited, which can trigger more accounting nuances, because if you go ahead and change the plan, it could again trigger a modification accounting for the share-based payment. The last would be the employee motivation, because if you have stock options which are getting lapsed or which are not vesting, it's essentially a loss to the employee, because they signed up for something as a motivation. They expected the company to do well, but because of this external event, their options are now worthless. So again, you may have to figure out other ways to compensate them, retain them, and motivate them. So a couple of things as in terms of action steps for share-based payments. I think the first one would be obviously reassess your model, whether it's Black-Scholes or whether it's binomial or whether it's any other model. And the third would be your overall HR policy. How do you want to deal with a scenario where your options are getting lapsed or vested because of the market conditions? I think the last topic we have for the day is business combination. So business combination essentially is the M&A activity. So if the company has acquired has done an M&A in the recent past, a couple of things that you would need to look at. So essentially, under the business combinations, the standard requires you to recognize the acquired assets and liabilities at fair value. What this really means is you do a fair valuation exercise and split your consideration that you have paid into property, plant, equipment, intangible assets, etc., and whatever is left is goodwill. Now, with this scenario, the fair value of the net assets acquired may have undergone a change and may require a revision, which means you may have to recognize an impairment loss for a new subsidiary or a joint venture or a associate that you might have acquired, so that you can reflect it at its recoverable amount today. For transactions where the acquisition date is yet to arrive, the reduction of net assets may result in an increased goodwill amount, and an increased goodwill means again you will have to test it for impairment. Or the other thing is that because it's still open, it's still being negotiated, you may have to go back and renegotiate the terms of those acquisitions so that it reflects the current market scenario. Also, a lot of these M&A activities have something what is called as a contingent consideration, which is based on an EBITDA margin after a certain period of time or working capital position. So there's always a certain element which is variable. Now, from an accounting perspective, the company is required to estimate that on day one and include that in their goodwill calculation. So again, because of these scenarios, the fair values will have to be reassessed, and if they've changed, they may have a corresponding impact on the business value, which means the goodwill or the value of the intangibles or the value of the PP that you recognize. So I think overall, you may have to again go back to the drawing board for some of these M&A deals, either renegotiate, or if it's already signed, then relook at the value so that you present it in a true and fair manner, considering the impact of the outbreak. So I think that's all I had from some of the key areas that may get impacted. Now, one area which it is directly dependent upon accounting is taxes. So for all the potential adjustments that we've discussed, there will be a corresponding tax impact for which you'll have to discuss with your tax consultant. If you take an impairment of inventory, whether that's allowed in tax, if it's an impairment of asset, how do you deal it with tax? What about share-based payment modifications? How do we, whether we get a allowance for that in tax or not? So for each and every decision you take from an accounting perspective, there will be a corresponding tax impact, which will get reflected either as a current tax provision or as a deferred tax provision. So I think that's something you should keep in mind as you assess your issues from a financial reporting perspective. and prepare for your year end. So before I close, maybe I'll run the last poll that we have. So Casey, maybe you can run that and open up for Q&A. Right. And if you have any questions, feel free to ask, and we can answer your questions right away. Right. So I think it's on the grant. So see, the timing of the grant would really depend. So if you're getting a grant which is upfront in nature, then you'll need to probably set up a deferred income if it's related to expenses. But if you're getting it as you go along, so if you get a check on a monthly basis from the government, then obviously it's not does not make much of a difference. Now, how you present it in the P&L is a matter of policy choice. You can either present it as other income, or you can set it off against the related cost. So if it's against salary, you can set it off against the related salary cost. But say, so in this example, you say if I get it based on October to July period, and you're a March year end, so from October to March 2020, there's no deferred income. So at March 20, your deferred income will only be for the remaining period, which is April, May, June, July, for 4 months. You can't recognize that in the P&L immediately. It will be recognized in the subsequent year. I hope so. Does that make sense? Right. So if we don't have any further questions, Casey, maybe we can conclude. And I think we're going to be circulating this deck anyway. So if you have any questions, please feel free to reach out to us, and we'll be happy to respond to your queries.